Hi, good afternoon, Asha. I just want to first thank you for taking time out of your busy schedule to have this chat with me about insurance and financial planning among other things. Quickly, can you just introduce yourself to everyone and just let us know about your path to becoming a financial advisor?
Okay, thank you for having me as well. Well, my name is Asha Forde. I'm 28 years of age. I have been a financial advisor at the leading insurance company in Barbados for almost 6 years now. I received my secondary education from the Alexandra School. I then went on to sixth form at the Combermere School and then straight to the University of West Indies. I then received my bachelor's in econ and accounting. At that time, I never imagined myself being a financial advisor. I thought I would have been maybe an FC at a successful company, anything like that. So I then went on to be an accounts receivable clerk at Miami. Then went on to being a junior accountant at another company. And while I was there, I ran into one of my primary schoolmates. And she was like, come on, meet my manager. And I went and meet her. She just introduced the job to me. I was like, would you be interested? And she just said basically it fit my personality to a T, well dressed, meticulous, and just if I would be interested in then something to pass on generational wealth in Black families. And I took a leap of faith, and the rest is history. November will be 6 years.
6 years already?
Yeah, that time flew.
Yeah, well, that's good. Congrats on that.
Thank you.
Yeah, you're welcome. In your own words, Asha, how would you define insurance? In your own words.
Okay. In layman terms, insurance is basically the protection from financial loss. Whether it's financial loss from property, house or contents, a vehicle, anything along that line, or life. Most may understand financial loss by losing property or vehicles, whether it's a natural disaster or an accident. The valuation of that asset is then calculated by an expert or maybe a dealer in the specific field, and you then insure it based on value. You will pay an annual month or monthly premium in the event you incur a loss, and the lump sum will be paid out to you in the event you did indeed get a loss. As it relates now to life is a bit more difficult to calculate because who am I to tell you how much your life is worth?
Understood, yeah.
You understand? So then from a parent point of view, one may say, well, my child is eight years old, and if anything happens to me today, how much will it take to raise the child up until adulthood or up until they could fend for themselves? And you may say, well, it may take 500,000. Then I may insure obviously my life at 500,000 in the event anything happens to me before my child reach 18. I know they will have obviously the finances to then take them through to that stage or to that age.
Okay.
Or, sorry, go ahead.
No, I'm listening.
Okay, or it would be someone indicate no children, but they want to start or get insurance from an early age. So they may have maybe debt, a bit of debt. So they will say, okay, I could only afford $100 a month, and then I would work the insurance based on that budgeted value.
Okay.
So insurance in a nutshell is the protection from financial loss. Losing something, and then you will obviously then pay a monthly premium. In the event that you lose something or life, you will then get the balance or the lump sum to then take you through or to replace it.
Okay, understood. I'm pretty sure that being in the field that you would have come across some misconceptions pertaining to insurance. Can you just give us an example of some of the things that you would have heard pertaining to insurance that you know isn't true, and what would you say to those people that have that second guess getting the insurance?
Okay, some of the misconceptions I hear regarding insurance are mainly geared towards life insurance itself. For example, buying life insurance is a death sentence. Some people often think as soon as they purchase insurance, they're preparing for death. Or another one is that there's only a benefit after you die and someone else receives the money. There are tons of living benefits from having obviously life insurance. It can give you collateral for mortgages. It gives you guaranteed amount for retirement. The cash value generation of the policy help in financial situations or financial. If you find yourself in a financial bind, sometimes the only place you may have obviously cash values or cash is in your insurance plan, and then you will be able to obviously take from it to help you in that situation.
Okay. One misconception that you hear often, I definitely heard it many times. I'm a young person. I really go to the doctor. I hardly get sick. Why should I go and invest? Well, yeah, invest my money in insurance. What would you say to a young person
Insurance
in
meaning
that regard?
insurance meaning life or health itself, because you would think you're in good health, because people don't have a problem insuring their house or insuring contents or insuring a vehicle, because obviously they know the value of that. So if anything happens, they know obviously I need a new vehicle, I need to rebuild, I need to replace.
Yeah.
But as it relates to life and health, because you are younger and healthier, it is cheaper to purchase life insurance, health insurance, or critical illness insurance. And you don't know if you will always be in great health, and free accidents do happen. So in the event you purchase insurance while you were young and in good health, God forbid,
Yeah.
in your 30s, you then were to become ill, the insurance can't be taken from you. You already had it when you were in good health, and you will be paying a less premium than someone who then come at an older age for the same amount of coverage. So it is good to start investing from early because it is cheaper and you will be in good health. So it would be better for you to purchase then.
But as you said, there are various policies, there are various insurance policies that are available to the general public. But for those who still are second guessing the insurance, what are some of the major policies that you would recommend as an advisor for even those who still to this day are second guessing the insurance?
Well, this will be based on affordability and the need for the specific individual.
Yeah.
But in a perfect world, I believe everyone should have health insurance,
Okay.
where if one becomes ill, the health insurance will subsidize health costs. This may have a deductible attached to it. So please make sure when you're purchasing your health insurance policy, you understand the deductible concept, meaning you may have an annual deductible of 500 annual deductible on your policy. This means every single year you need to cover $500 in medical expenses before the insurance company kicks in and starts to cover or subsidize the actual amount at the doctor. This is different from dental and vision, because you may have a 500 annual deductible on medical expenses, but your vision and dental may be 50 or 75. So once you spend $75 at the dentist, then the insurance company kicks in. So the 500 and the annual medical deductible is different from the vision and the dental deductible. So make sure you understand obviously the difference and what is your deductible. There are some policies from day one. If you go to the doctor for medical expenses, surgical kicks in, or the insurance company kicks in and cover that premium payment. The second one will be critical illness. This is the type of insurance policy. If you were to be diagnosed with one of the listed critical illnesses, you would receive a lump sum payout. A lot of people don't understand the difference between this and health. With a health insurance policy, it protects you in the event of a medical emergency. It covers whole or part of the medical expenses incurred by the insured or are dependent on that health insurance. With critical illness coverage now, it provides financial aid in the form of a lump sum payout in the event you were to be diagnosed with a critical illness, God forbid. For example, if you had a critical illness cover for 250,000 and you were diagnosed with stage 1 cancer, it isn't obviously serious, but not at a grand stage, right? If you were to, you would then receive that 250,000 in a lump sum payout because of that diagnosis. Just to name a couple: critical illnesses, heart attack, stroke, cancer, major burns, blindness, loss of limbs, loss of speech. Those are a couple. So with the critical illness, you receive a lump sum, and with the health insurance, it subsidizes the actual cost.
Okay.
The third type of policy I believe everyone should have in a perfect world is an endowment policy as well. This gives life cover from day one of approval up until the endowment matures. At maturity, the lump sum is paid out to the insured. So if you live up until the endowment maturity, you would then get the lump sum. God forbid, if you pass away before the maturity, your beneficiary would then get it. This policy is a cash value based policy, meaning it generates cash values along the way.
Okay.
Endowments can be a specified time. For example, a 10, 15, or 25-year endowment, which is often the same price for a 20-year-old and a 40-year-old. Because no matter the age, it matures in 10, 15, or 20 years. One can also purchase an endowment to a specified age, 60, 65, or 70. This type of endowment differs in premium payment because a 20-year-old has more years to reach 65 than a 40-year-old, and that will cause the actual price difference in the actual endowment.
Okay. Okay.
But as a millennial, I would recommend every millennial to purchase an endowment because it gives you a secure way to guarantee a lump sum payout at a specific age. Imagine 25 years old, you purchase an endowment, a 25-year endowment for 100,000. No matter how their finances change, no matter what happens in the global market, it is guaranteed for you to receive that 100,000 payout at age 50. So if you have a mortgage and it has $55,000 left on it,
Yeah.
you know for sure you could clear your mortgage, be debt free at 50, and then still have like 45, obviously, to supplement your retirement or to help you in that time.
Okay. Okay.
Mm-hmm.
Understood. Understood. I just heard you mention the global market. Regardless of what's happening in the global market, the endowment plan is certain. Well, sticking on the global market there, I want to ask about the mutual funds. With all that's going on now, due to regarding COVID-19, the global market has definitely taken a significant hit. So, for someone who was looking to invest now in mutual funds, what advice would you give to them?
Well, they need to understand what a mutual fund is, but this is not my professional field, so I would rather not give advice on that per se,
Okay.
but I could put you on to someone who specializes in it. Basically, a mutual fund is established to invest in many firms. When you buy mutual fund shares, you become a shareholder of a fund that has invested in many other companies. So by diversifying a mutual fund spreads it risk across numerous companies, and rather than just relying on one to just perform well.
Yeah.
So it is good in diversifying risk.
Yeah.
However, I would then have to put you onto someone who specializes in that.
Okay, no problem. Uh, as a millennial, I'm pretty sure you get questions pretty often about, how can I create a steady financial plan uh, outside from the insurance. I'm pretty sure like I said, pretty sure you get these questions often. What can you tell me? What advice can you give me about how should I create a steady financial platform as a young person?
Okay. To start, I think one should have two commercial accounts. Basically where your salary goes into or is deposited into if you deposit your checks, if you're paid by your check. This account is the account you will conduct your monthly transactions through, pay your bills, grocery shop, etc. You'll be able to track your spending habits, your daily logs, everything. And then an emergency
No,
fund.
sorry. This is the account that
Sorry,
this is the
you're
account.
paid through.
Okay, okay,
You're paid through. Your salary is deposited into, and
okay.
then you would obviously use that as the one to pay bills, put gas in the car, grocery shop. So you'll be able to log it. If you log into online banking, you'll be able to see how much you spend and track. Then an emergency fund, I would also put that at a commercial bank because you would have easy access to it. You will have an ATM card if you have an emergency in the nighttime. You would then obviously be able to, if you have a flat on the car, you need to go to the doctor, anything like that, you would have access to. This is not an account you would obviously dip into. You only go into this account as long as you have an emergency. So you save in this account monthly, You would transfer from the checking account or whichever account you're paid through as a monthly deposit for that emergency account. Then the third account would be a credit union account. Basically, this is your short-term goal account, 3, 5, 10 years. You save monthly in it, but you only go into this account as long as you reach the short-term goal, whether it's the deposit for your first piece of land, the legal fees for the mortgage, anything when you get to this obviously 3, 5, or 10 year plan. And then finally, I would always say in that financial foundation needs to include health, critical illness, and life, and a retirement plan or two. Because once you start planning for your retirement from a young age, the less money you could put in monthly and then still reap great rewards when you get to 60, 65, if you decide to retire at 50, 55. Because if you start to plan for retirement from 40, you're scrambling in 10 or 15 years to then reach a lump sum figure. It would be so hard for you to obviously do other things and still afford to plan for retirement. So it's better to start early, that you would have an affordable amount and still be able to do the everyday things you would like to do. So
Um,
for the financial foundation, that's it basically.
okay. I recently heard some. Well, sorry, I read. I can't remember where it was I read, but I saw some an article that basically said you should have at least 6 months uh, of your salary put aside for a rainy day. Um,
Salary, I would say 6 months expenses. Because 6 months salary, your salary is taxed. You don't even get your salary in your hand full. So, and if a rainy day comes, I don't think you will still be doing stuff that if you have your normal salary, it will still, you understand? So things
understand.
like rent, utilities, debt, fixed debt payment, stuff like that, you should have that in an account for a 6 month span. If it takes 6 months for you then to find a job, 6 months for things to go back to normal, 6 months for, so it would give you an adequate amount for you to be able to hold yourself together up until then. So yeah, wow.
Okay, understood. Um, I heard you speak about retirement, or you preparing for retirement as a young person. The early it is, the better it is for you. So can you just dive in a little bit more to the retirement part? How can I save through for my retirement through insurance?
Endowment plans are the best way to save for retirement because you get that guaranteed lump sum. With a whole life policy, you only have access to a portion of the um, sum assured. So, for example, if you have 500,000 in cover in a whole life policy, you may only have access to maybe 100,000 at 65. Whereas if you have an endowment, if the cover is 500,000, you guarantee to get that 500,000 at that specific age. So I often try to get my clients to 500,000 by 65, but in different intervals. So I may give you a 25-year endowment. So in 25 years, you may receive 100,000. Then it may give you an endowment to age 60 for 250,000. So then by 60, you would have then got 100,000 in 25 years, and at age 60, you would then get another 250. I hope you don't blow all by then. But in the event you were to blow all by then at 65, you will got another endowment coming in for at least 200,000. So you would then get another 200,000 at 65. So whatever you if you pay off your mortgage with a 25-year endowment, then you will have the 60 and the 65. If you decide to then wait till retirement and then clear the mortgage, well, you may have invested the 25-year endowment in something else to bring obviously income all the time. Obviously, when you get to retirement age, so you would have invested that endowment. So I just try to get the clients to at least 500,000 by 65 in different types of endowments, maybe 20. And you don't have to purchase all of them together. You may start with me at age 20. You start a 25-year endowment, and then in 2 or 3 years we revisit. You may change jobs, you may pay off a debt payment, so you have more, albeit more surplus.
Okay.
So then you'll be able to obviously invest in an endowment to age 60. So it's done in intervals. You don't do it one time. So you start somewhere, and then by age 65, hopefully 500,000, and then you may have a retirement plan with work. So that will be the retirement check you will get each month, maybe to pay utilities. But you need a lump sum. If you decide to wake up at 16 and say, okay, going to Dubai today, you could go. Like you feel like you work and you deserve to,
Yeah.
and endowment would give you that lump sum to do whatever you see fit to do with the money. If you want to send your children to college because you want to give them a better start than you have without a student loan debt, you can then decide to obviously give them that endowment as a gift. But endowments are the best way to save to retirement through insurance.
Okay. Sticking on the endowments, but I'm pretty sure that with the endowments, there's a fixed amount that you pay monthly. So just a scenario, let's say 3 years down the road, I found myself in some financial difficulty and I'm unable to, make the monthly payments, but I also would like to have access to that money that I, have been putting on for 3 years, although it hasn't reached the maturity stages yet. Would I be able to have access to that cash?
Yeah, sure. Once the cash value started to build or started to generate on the policy, you would have access to your cash values at any point in time.
Okay.
So if you need the money, you would then, the check is often ready in maybe 24 to 48 hours. Once the cash values are on the policy, you have access to the cash values. But just remember, it's a cash value loan. You are basically borrowing from your future self or your future payout. So you can pay back your cash values, so you will still get what you projected from the beginning. So for example, if your policy cash values were 10,000 and you took 8, you could then obviously pay back the cash value maybe along the way. So you would then obviously get back the 100,000 you bargained for maybe at age 20, at age 45, you still getting back this 100,000.
Okay.
But once cash values are generated on the policy, you will have access to your cash values at any time.
Okay, understood. I just wanted to clarify that. Okay, I want to move on now to the building part of insurance. A lot of young people know we are looking to purchase our own homes. As a financial advisor, what do I need to know? What's the first thing you need to know going in to purchasing my own home from an insurance point of view?
Well, when looking to purchase your first home, once you have an idea of how much you qualify for or the maximum you intend to spend, make sure you have enough life coverage for that amount, because you would need it. If you decide at age 30 you're going to go for your first mortgage and you're spending no more than 450,000, but you're 21 and you can't afford to purchase the insurance for that amount at 21, purchase it, because at age 30 it will cost more and your budget will be more tight. So then once you get into a habit, for 9 years paying this insurance, it becomes second nature. So once you know how much you intend to spend or you are looking to spend or what you qualify for based on your salary, get the life coverage for that amount. Sorry. Also take into consideration, other than life insurance, you need to budget for home and contents insurance, because once you have a mortgage, you will need to have obviously home insurance on the property. God forbid if anything happens, the insurance will pay out to obviously clear the mortgage or to rebuild. Because if anything happens, you still have that mortgage payment where you want to make sure you have a house too. But please know, having life insurance does not guarantee you to be approved for your mortgage. The financial institution you go to still have their specific requirements as well. So you may have your life insurance cover, you may have everything in place, but something may stop you, and credit history, credit rating, something. So still make sure you know the requirements for the financial institution as well when going for your mortgage. So I don't want you to think you can buy the life insurance and this guarantee you to get this mortgage. It doesn't guarantee you, but it put you in a position for, once it is approved, you already have the collateral, obviously, for this mortgage.
Okay, Asha, I just want to ask one more question. what measures can a parent put in place to ensure that their child is covered in the event of any uncertainties?
This is kind of a touchy situation because I'm not a parent as yet. However, before you purchase insurance on your child or children, make sure you have coverage for yourself. The child is not the provider in the home, you are. And God forbid if anything happens to you and the child only has coverage, the insurance company will not pay out a lump sum. It just continue making the premium payment up until the child reach adulthood. So make sure you have coverage on yourself and then the child as the beneficiary. So if anything happens to you, the lump sum is then paid to the child. You understand?
I understand.
So, but you can purchase a short-term endowment on the child or a short-term policy on the child. So after university, if that's the route they decide to take, you can give them a lump sum to start their life rather than a student loan debt. If they want to invest, if they want to start their own company, you can do that. But I recommend the coverage on the parent before the cover on the child. And then once you can afford to give the child coverage, then you do it. Because if you give a 10-year-old $1 million in cover, they will pay that premium payment up until whenever. So they wouldn't have to look at age 20, age 25, age 30 to then start $1 million policy. They will already have it in place. And maybe just call in a figure. This is not a generated figure, but you may be paying $102 for $1 million because the child had it covered from the time they were 10 years old or 8. Yeah.
Okay.
So it would make more sense then, but only do that if you can afford to have coverage for yourself and then the child. But I always recommend the parent to have the cover on themselves before they purchase on the child.
Okay. Asha, I want to thank you for joining me. It has been very informative. And I wish you all the best going forward in your career.
Thank you so much.